Donald Trump is not holding back. When he announced tariffs on Mexico and Canada, the Republican president gave himself a month of grace, a month in which he might rethink attacking his best trade allies. In the end, he did end up imposing tariffs, and the same story has repeated itself, this time with Europe and the rest of the world. Many people believed that this time it was going to be different, that Donald Trump would come to his senses when he saw Wall Street in the red, and that he ultimately would not impose general tariffs. But those who thought so could not have been more wrong. Trump has arrived without brakes and is not willing to back down, quite the contrary. Despite the fact that there hasn't been a single piece of positive economic data since the new tenant of the White House became president, Donald Trump seems convinced to continue with his strategy no matter what happens, and no matter what it costs. The question is, why? Well, there are two possibilities. The first is that Trump is a madman, a fanatic. He doesn't give a damn about reality. If the economy doesn't react well to his policies, well, hey, that's just the economy being wrong. But in fairness, there's also another possibility. According to their perspective, the Republican administration may be thinking about looking at the longer term. The data may be terrible right now, but for them, it may be a small sacrifice in exchange for achieving a much larger goal. The problem is that goal may take away all the key factors of the success of the last few decades. But no matter, in the White House, they dream of a very ambitious goal, nothing short of changing the international financial order. For many decades, Europe and the rest of the world have been living under the US umbrella, and we're not only talking about the military umbrella, but also the financial umbrella.
The U.S. provides reserve assets, serves as a consumer of first and last resort, and absorbs excess supply in the face of insufficient demand in other countries' domestic models. This system is not sustainable.
Visualeconomik community, Wall Street is afraid. Afraid that the US will cease to be the largest provider of financial assets globally. But at this point, it seems clear that Donald Trump doesn't really care what Wall Street thinks. In fact, many voices within the Republican Party are already calling for a U-turn in US monetary policy, a turnaround that would imply devaluing the dollar. But not only that. Within Trump's trade policy, there's a huge contradiction. Trump wants to devalue the dollar to make the US an industrial power again, instead of a financial power. But at the same time, he also wants to punish countries that stop using the dollar as a reserve currency. And let's see, money is like any other commodity. It follows the laws of supply and demand. If people demand dollars as a reserve currency, then the dollar appreciates. In other words, Donald Trump wants the advantages of having a weak dollar, with the advantages of having a strong dollar, but without the disadvantages of either. This seems impossible. Crazy. But what if I told you that there is a plan to try to achieve it? I'm talking about the Mara Lago Accord. Remember this name because it could be one of the most important events of this century, a turning point in world history. But what does this deal consist of? And how on earth does Trump plan to devalue the dollar while remaining the global reserve currency? Could this plan really work? Well, today on Visualeconomik, we give you all the answers. To understand what the Mara Lago Accord is all about, we have to go back in time. Because no, this is not the first time an agreement to devalue the dollar has been suggested. New York, 1985. Michael Jackson launches We Are the World. Back to the Future is released, and Ronald Reagan is at his peak. In that year, representatives from the United States, France, West Germany, the United Kingdom, and Japan met at the Plaza Hotel to sign a historic agreement, the Plaza Accord. What did it consist of? Well, you see, after the end of the Bretton Woods system, the world set out to explore the then wildlands, floating exchange rates between fiat money. And since the experience was new, you can imagine the chaos that global monetary policy became at that time. What's more, Paul Volcker, the Fed chairman, had raised interest rates above 20% to fight inflation. This made US debt extremely valuable, because you tell me what other asset pays that kind of interest with practically zero risk, and not surprisingly, that sent the dollar skyrocketing. To give just one example, between 1980 and 1985, the yen devalued by 50% against the dollar. Yes, that's right, 50% in just 5 years. But in the midst of all this financial chaos, a seemingly impossible agreement was reached. All the countries gathered at the plaza agreed to devalue the dollar progressively. The US undertook control of its public finances so as not to flood the world with debt, and the rest of its partners sold part of their dollars, but without provoking a stampede. The intervention was a success, although the depreciation of the dollar began half a year before these agreements. The reason? Because what was important was not so much the agreement itself, but the expectations. The Plaza deal sent a clear message to the market. The US wanted a cheap dollar, and the rest of the world was going to help them get it. But pay attention, because this agreement did not only serve to devalue the dollar, it was also a means to achieve the main objective: to close the trade balance. And in this too, Reagan achieved his goal. While in 1987, the US had a trade deficit of $150 billion, 4 years later, that figure was down to $30 billion. And now that you have all this context, take a look at the following chart. What you are looking at is the value of the dollar against a selection of other currencies. As you can see, since the financial crisis of 2012, the dollar has not stopped appreciating, and is now almost as expensive as it was during the Plaza Accords. Do you understand now why there is so much talk about the Mara Lago Accord? What's more, Donald Trump is said to be such a fan of this Plaza deal that it even influenced his decision to buy the Plaza Hotel itself, although he later had to sell it at a loss. But we live in 2025, not 1985. And the world is very, very different from what it was 40 years ago. Today, a deal like the Plaza one would be much more complicated. And it's not even clear that it would be positive, even if it were signed. Be that as it may, what is clear is that the Trump administration is determined to see it through, and that they have outlined a plan to try to achieve it. So I think the time has come to introduce the protagonist of this story, the head of Donald Trump's Council of Economic Advisors, Stephen Miran. And keep one thing in mind. Donald Trump is completely unpredictable. But luckily, his top advisor is very transparent with his ideas. Miran begins his essay by saying that Donald Trump has won with a huge majority, so he has the legitimacy to make a radical change in the position of the dollar, which is the real financial and economic heart of the US. And he also admits that this is going to upset Wall Street a lot. But he makes it clear that, in his view, to make an omelette, you first have to break some eggs. According to Stephen Miran, the dollar is highly overvalued relative to other currencies due to its role as a reserve currency. This increases the demand for dollars, which makes the currency more expensive and hurts the manufacturing sector, because with a more expensive dollar, it's much more difficult to compete against other countries. On the other hand, other countries, such as China, can undercut their products by simply devaluing their own currency. What's more, in his opinion, the cheap debt that the US receives in exchange for its dollars is mostly used to finance US consumption, rather than to invest and improve local productive capacity. This in turn generates a vicious circle. Less industry makes the country dedicate itself even more to the financial sector, so that when the financial sector does well, the dollar becomes more expensive, which further damages local industry, and so it starts all over again. But of course, ending this vicious circle would imply ending the role of the dollar as the world's reserve currency. And Visualeconomik community, if this were to happen, forget about things like sanctioning Russia for the invasion of Ukraine. Overnight, the US would lose one of its most powerful geopolitical weapons, a weapon that not even China can copy. On top of that, what Miran forgets is that the US also benefits from this system in a much more indirect way. You see, dollars and US government debt are the only safe asset that can pay the interest rates it pays, and that, moreover, can be issued in such massive quantities. And that's why many emerging countries depend on these assets to stabilize their own economies. Without dollars, these countries would stop growing economically, and in the long run, that means the US would lose a huge market, which would end up hurting its own interests. And so, Stephen Miran suggests a formula for devaluing the dollar without losing reserve currency status. Check it out.
The Trump administration can attempt to find ways to capture back some of the benefits other nations receive from our reserve provision. Reallocation of aggregate demand from other countries to America, an increase in revenue to the U.S. Treasury, or a combination thereof can help America bear the increasing cost of providing reserve assets for a growing global economy.
Yes, I know many of you find this as clear as you did before, so let me explain where the Mara Lago agreement could be heading in a simpler way. Stephen Miran, and by extension Donald Trump, want other countries to sell their dollars to devalue the currency, but they also want them to directly or indirectly finance the US to remain dependent on the American empire. In particular, the most talked about proposal is for the European Union, Japan, and even China to swap their short-term US debt for 100-year bonds with very low or even zero interest rates. Thus, demand would fall, the dollar would depreciate, but countries would continue to rely on US debt as an international reserve currency. And yes, I know what many of you are thinking. Why would a country exchange a debt that pays quite high interest for one that pays nothing, or practically nothing? Well, here's the other crucial aspect of the Mara Lago Accord. If you remember, we started this video talking about tariffs. We told you that tariffs were a key part of this agreement. And the answer to the question we have just asked you is very simple. Countries would make this change simply because if they don't, Uncle Sam will bully them as much as he can, particularly with tariffs. In other words, it will make them choose between the bad quasi-expropriation, that is, exchanging short-term debt for bonds at least 100 years that may not even pay interest, or worse.
Recall that President Trump views tariffs as generating negotiating leverage for making deals. It is easier to imagine that after a series of punitive tariffs, trading partners like Europe and China become more receptive to some manner of currency accord in exchange for a reduction of tariffs.
Of course, achieving this will be very complicated. In 1985, almost all dollar reserves were in the hands of US allies, Europe and Japan. But today, these countries are not such allies, precisely because of Donald Trump, nor is their presence so great in the currency market. For example, the forex reserves of the Eurozone are approximately $280 billion, but those of China are $3 trillion. This is according to official data, because the real figures are probably much higher. But this is not all. Singapore has $350 billion. Saudi Arabia, $450 billion, and India another $600 billion. In other words, in order to work, the Mara Lago Accord would have to be signed by many more players than the Plaza Accord. So let me ask you, do you really believe that China is going to sign an agreement to lose tons of money, appreciate its currency, and benefit the US? The truth is that the precedents are not very positive.
In trade rivalry with the US, China will not become another Japan. Japan paid the price for the Plaza Accord, experiencing economic stagnation as a result of currency devaluation and shifts in global trade dynamics. China will not allow the US to play the same trick on it now.
When we told you about the Plaza Accord, you may have thought that this was little more than a friendly meeting between colleagues, right? Well, nothing could be further from the truth. In 1985, the US also had to threaten its partners to devalue the dollar, and the major loser was Japan. Following this agreement, Japanese exports and GDP growth fell by half, beginning Japan's infamous lost decade. What's more, according to many economists, the appreciation of the yen also contributed to the great financial crisis of the 1990s. Now, to be fair, although the Plaza Accord clearly did not benefit Japan, it's not true that it was so disastrous either. The main cause of the Japanese crisis was not the yen, but the economic stimulus that was approved a few years prior. According to one study, interest rates were 2 to 4 percentage points lower than they should have been. And then to this was added a large package of public spending and tax cuts. You know what was ironic? That Japan's experience was something of a self-fulfilling prophecy. The Japanese authorities were so afraid that a strong yen would cause a recession that they doped the Japanese economy with steroids, which ironically caused a recession when the binge wore off. Also, in case you were wondering, the Plaza Accord did not cause the financial crisis or the housing bubble. Having said all that, let's not kid ourselves either. Don't imagine that the agreement benefited Japan. So let's be clear, it's going to be very tricky for something similar to be signed today. And as if this were not enough, central banks are now much more independent than they were 40 years ago. And the US has 3 times more public debt as a percentage of GDP. And so a devaluation of the dollar could force the Fed to raise rates to combat inflation. But of course, refinancing so much debt at such high rates may be prohibitively expensive for the federal government. And in any case, let's make one thing clear. The Plaza Agreement served to momentarily close the US trade gap, but its impact on the US industrial sector was basically zero. And there is a critical error in Stephen Miran's view. A strong dollar does not help the US manufacturing sector. That's true, but it's far from the primary cause of deindustrialization. If we compare it with other countries, it's very clear. The US is by far not the country that has deindustrialized the most. There are many other countries such as Germany, South Korea, and France where the industrial sector has fallen much more in the last 20 years, despite those countries not having the world's reserve currency. Added to that, the industrial sector is starting to fall even in China itself. If it has dropped sooner in the US than in other countries, it's simply because the US economy was the first to ride the software wave, a more productive sector than industry. Or, to put it another way, the US deindustrialized earlier because its economy was more productive, more agile in moving resources to the most productive sectors. What's more, the idea that the US has to maintain brutal deficits as long as it continues to hold the world's reserve currency is absolutely false. The world wants US debt, yes, but the US can issue that debt and buy other foreign assets, so the net debt, so to speak, need not increase. In fact, this is precisely what happens. About half of the debt and other assets that the US issues and that end up in the hands of foreign investors are offset by the assets it buys from other countries. On top of that, if it only offsets half of the issuance, it is precisely due to the deficit. Europe, for example, has the second largest international reserve currency, but its balance of financial flows is positive. According to Miran, a deficit is inevitable. But this isn't true. The US could run a surplus and still provide the world with the international reserve currency. And let's see, we're not saying this is a good idea. The US can afford a moderate deficit, more so than other countries, and certainly nothing is forcing them to exceed 5%, as Donald Trump is doing. Besides this one, Miran also makes other very basic economic mistakes, such as thinking that VAT, the consumption tax, functions as a tariff because it does not apply to exports. But this makes no sense. VAT is levied on all goods consumed within the country equally, regardless of where they come from. And don't think that this is the only error in this theory. It's not even the most significant one. The heart of this policy is that it is normal to have a balanced bilateral trade and financial balance with other countries. And if this isn't the case, it's because there is something that's distorting trade, whether it's the dollar or the monetary policy applied by other governments. But this is not true. And if you don't believe us, listen to someone who won the Nobel Prize in Economics for his work on international trade.
The period when trade was roughly balanced country by country did span a period of something like 60 years or maybe a bit less, but that was not a state of nature. That was because in the interwar period and for a number of years thereafter, there were extensive government controls on the movement of capital. And what happened after around 1970 is that we started to return to the historical norm in which capital flows quite a lot. Paul Krugman.
If the US has a large trade deficit, it's not due to the dollar, but because its economy is so productive that it attracts a lot of investment. And by pure accounting, that implies trade deficits. But these deficits don't generate any problems. Quite the contrary. The only alternative to balancing the trade balance without sacrificing all this investment would be to increase domestic savings by 3 points of GDP, which would imply closing half of the fiscal deficit. Meanwhile, Donald Trump is just making it even bigger. And Visualeconomik community, there's still one last criticism to make of this Mara Lago Accord. The initial idea is to devalue the dollar without sacrificing the position of international reserve currency, and to do so, Trump wants other countries to exchange their short-term debt for 100-year bonds. This may work in the short term, but one of the main reasons why the dollar is the reserve currency is that it's very predictable. If Trump were to carry out such a drastic change, the rest of the countries would be even more distrustful of the US, and no matter how much 100-year or perpetual bond they have, they would try to reduce their exposure to this country. In short, no one knows what Trump will do in the future, but it's clear what his top advisors want to do. However, the world right now is very different from the world of the Plaza Accord, and achieving something similar would be virtually impossible. But even if it succeeded, it would be useless. The White House would have lost all its credibility and the support of its allies for nothing, because devaluing the dollar will not solve the United States' problems. But having come this far, it's now over to you. Does Trump really plan to use tariffs to negotiate this agreement? Do you consider it likely that we'll see a Plaza 2.0 agreement? And if so, would it really benefit the US? You can leave me your answers down in the comments. And as always, don't forget that here on Visualeconomik, we release new videos every week, so subscribe to this channel and hit the little bell so you don't miss any of our updates. If you liked this video, like it, and I'll see you in the next one. All the best, see you soon.